Hi, I'm Neppy and I invest the world. Mostly equities right now on the ASX, but hopefully that's going to change with time. Today I'll be discussing one of Australia's, if not Australia's greatest company, CSL, and their financial year 20 results released on 19th of August. Hopefully most of you have heard about CSL. In fact, I'd hope most Australians have heard CSL by now, because it is Australia's biggest company on the ASX in terms of market cap. It's overtaken CBA and actually does have a bit of a good, interesting history, especially in 1994 when it went private. So it actually was originally a government company or business or enterprise named Commonwealth Serum Laboratories. And they did very similar things to what they do now. So blood products, vaccines, antivenom, that sort of thing. So through all their wisdom, the government decided to sell Commonwealth Serum Laboratories or privatise it in 1994 for an overall value of $292 million. And they're selling shares at $2.30 a share. That stock had split adjusted at 77 cents. They did a 3-to-1 stock split in 2007, I believe. And they probably paid someone a couple of $1 million to come off the name of CSL. And this person probably spent a couple of weeks just thinking of names. And then they just thought, I'll just take the first letters of Commonwealth Serum Laboratories, and that's the name, CSL. So that's government for you. And that's a joke. I'm just making that up. Anyway, I did read a paper written in 1995, and I'll put the link of the paper in the comments. And they just went through this privatization of CSL, looking at financial, whether it made sense financially. And they came to the conclusion from a taxpayer's viewpoint that privatization of CSL was a disastrous transaction. And when you look at what CSL is worth now, maybe they could double down on that. But of course, they did mention that government may not have privatised CSL for financial reasons. It may have been for some other reasons. So today, CSL is the third largest global biotech. So it is a global company. The results, when they release their results, they are in US dollars. They have manufacturing in many companies or many countries in the world. So the headquarters of their two divisions are in, I think, either USA, maybe Switzerland, that sort of area. So in different sections, like the number one company in the world in plasma therapy. So you may have heard they have plasma collection centers throughout the world. And there's a lot of concern whether those plasma collection centers, how much of a hit they were taken through COVID-19. Looks like it wasn't as much of a hit as some people thought. The number two company in the world when it comes to influenza vaccines. So CSL, if you actually, I think they did release announcements on the 7th of September. So the announcement did suggest that CSL was to manufacture, supply University of Queensland and Oxford vaccines candidates for the Australia. So they are pretty high in the influenza vaccine area. Now, the market cap today is $130 billion, or 444 times greater than its 1994 selling price. Share price is just over $280 a share, or about 370 times greater than the 1994 issue price. As I mentioned before, there was a 3-for-1 stock split in 2007. It was getting a little bit expensive, so they decided to, decrease the price of a share. And if you've been following the news overseas, Apple and Tesla have just done stock splits in the last few weeks. And for some reason, as soon as both companies did a stock split, the share price just skyrocketed because people just think it's cheaper. But of course, it's not cheaper. It's just a perception that it's cheaper. And if you're lucky enough to buy $10,000 worth of shares at the IPO in 1994 and you were patient and just held until today, that $10,000 is now worth $3.7 million. Hindsight, 2020. Wouldn't it have been great if we bought some shares back then? Oh well. I suppose we're on the lookout for the next CSL. So what does CSL do? So they have two divisions created through acquisitions and whatnot. So the first division is CSL Behring. I'm not sure if I'm pronouncing that right, So they did acquire Behring in 2004. In 2000, they purchased a Swiss plasma company. And this CSL Behring, they just do products to treat rare and serious diseases such as haemophilia. So some of the areas they're interested in is immunology, hematology, cardiovascular, and metabolic, respiratory transplant. Securus, I think that's how you pronounce it, is more into vaccines. So it is the world's second largest influenza company in the world. And it's sort of emerging between what CSL did in their vaccines division and they did an acquisition with Novartis influenza business, and they merged those two together, and is now the second largest influenza vaccine company in the world. They also do anti-venoms, so they do stuff like box jellyfish, brown snake, funnel web, stonefish, that sort of thing. Really, when you look at it, they do great things. One thing I really like to look at is the pipeline of future stuff they're doing. So this is just breaks down the little sections. So immunology, hematology, for example. In hematology, they do have two hemophilia drugs or treatments that have gone post-launch. So Ardelvian and Afstelila, whatever it is. Sorry, pronouncing these horribly. But I just like to look at these and see what's potential pipelines of products they have in the future. So got quite a few there. Transplants and then influenza vaccines, a lot there. And then they're also doing COVID-19 stuff there. So overall, they are doing great things for humanity. CSL, I suppose if you do take ethical considerations into play when you are investing, you can't go wrong with CSL. Now, I'm all about innovation. In my opinion, Australia's obsession with dividends is actually harmful to the country overall because dividends suppress innovation and growth. Now, you can have dividends, and CSL does provide a small dividend, but it's not a very large dividend. But a lot of the money they make, their cash flow, free cash flow that comes into the business, a lot of that goes to research and development, innovation. So they're spending $922 million in research and development. I think they spent that in the previous year. So the best way to grow is through innovation. Companies like Telstra, the banks spend very little money on innovation, and that's why they're not growing. In fact, you'd see maybe through the next 10 years, a lot of those companies' dividends actually will go backwards because just not innovating. So I like to read like this sort of thing to see what their mindset is when it comes to innovation and their strategy. So strategy, innovation all goes hand in hand for future growth. So most importantly, let's go to the financials. So all their financials, when they do their reports, are in US dollars. So I've just converted these to Australian dollars just to have a good look. So I'm not comparing year on year here. This is just raw numbers for this year. So you can just see revenue, profits, operating cash flow, fairly high. Talking billions of dollars, gross margin 57%. Share price yesterday when I was doing this recording, $282.13. Shares on issue 454 million, so market cap of $128 billion. And they do have net debt. I think net debt is not a problem with this company because free cash flow, you can see the operating cash flow is 3.6 billion. So they can service that debt quite well. Typically, I like to see lower debts, but I think this occasion it's okay. And then those two last ones, EV on operating cash flow and PE ratios, just two evaluation metrics I do look at. The first one is one I really look at. The PE ratio is one I think the general public and most investors have a good understanding of. Those two valuations are quite rich, in my opinion, but are they rich? So when you're talking about are they rich or not, I think you need to look at the growth of the company over the last 10, 15 years and future growth prospects in the next 10 to 15 years. So what I've done on the next slide here is just gone through the results over the last 15 years. I've gone to 2006, 2011, 2016, and 2020. So once they get to 2021 next year, I'll put some of those results in and just look at that overall trend. So the overall trend is all up. So really good growth. Look at revenue. It's gone from 2.8 billion to 13.3 billion. even gross margins increasing. So it's gone from 40% to 57%. Net profit after tax, the first one in 2006 is a bit misleading. And this is why I'm not the biggest fan of net profit after tax and then PE ratios. You can see PE ratios at 84 in 2006. Now, the reason net profit after tax, and you can look at the reason that is too low when you look at operating cash flows, 522 million. And you can see if you compare operating cash flow to net profit after tax, 2011, 16, and 20, they're not much different between the two. So there is some big difference or reason behind the low net profit after tax in 2006. So I actually did go back to the 2006 results and had a look why. And the net profit before contingent considerations was actually 351 million. So contingent considerations had to do with the acquisition of Bearing. So there was something to do with that. Didn't have a close look, but so that number is a little bit suppressed. So they did have a net profit before those contingent considerations. It was a little bit higher than that. In fact, it was almost 3 times higher than that. Everything else, you can actually see shares on issue, SOY, there has gone down, which, and the reason behind that is they've done some share buybacks. I'm not the biggest fan of what CSL did with share buybacks because I only like share buybacks is if the company is undervalued. That's when it really adds value. So I sort of think that is sort of a misallocation of capital. That's just my opinion, but good luck to them. And sometimes you see management do that. So if you decrease the amount of shares on issue, the EPS, the earnings per share, will increase if everything else remains the same. And a lot of times they have remuneration considerations when it comes to EPS growth, not anything else. And you see some management companies sort of manipulate EPS by doing share buybacks, which is not for the good of the company, only for the good of themselves. I don't think CSL falls into that category though. Earnings per share just really increasing throughout the years. Market cap's gone from $9.8 billion in 2006 to $126.7 billion when I looked at this. And operating cash flow has just gone through the roof too. And PA ratio, if you take away 2006, we're starting to see it increasing. So traditionally, it's a little bit lower than this. So we are at the high end of the PE ratio. And same thing with the earnings, enterprise value divided by the operating cash flow, which sort of is a ratio, valuation ratio. Back in 2006 and 11, it's under 20. Now it's approaching 40. So typically, I like to see that a little bit lower than that. For value plays, for instance, I like to see that ratio at 6 or less. So CSL is definitely not a value play. And a little bit of a rant here. I've seen some value investors talk about companies like Cochlear, Seek as value companies. They're not value companies. No. In the true sense of the word. I believe when they make an investment in equities, believes it's value because you wouldn't buy something if it's not a value. So if you're buying CSL shares right now, you believe there are value because they're going to increase in price tomorrow or the next day or a year from now. But in the traditional sense of value, CSL is not a value play, Cochlear is not a value play, Seek is not a value play. And look at the share price right at the bottom. It's gone from $18 in 2006 all the way to $282. So I was a shareholder of this back in 2011. I did sell out at about $70 because I thought it was getting, a bit rich in value. So that's a little mistake I made. So I acknowledge mistakes. I should have just held on because people have been saying CSL's been overvalued for a long time and it's still overvalued. But I think for CSL, you have to pay a premium because it is a premium company. Now, they did have some outlook for next year. Now, this did give me pause because they are expecting a little bit of growth. So this CC is constant currency. So it's just taking into consideration currency plays because you have to convert currency from US to Australian. But the main thing is looking at their net profit after tax in financial year 20 compared to what they're forecasting. Not much growth there. In fact, there's a possibility if you're looking at forecast, then profit's actually going to decrease next year. Now, I think CSL management have a history of under-promising and over-delivering. That is definitely a possibility here. That is my favourite play of management. If they're continually doing that, I like that. It does lead to a sort of it's much better than the reverse, which is over-promising and under-delivering. That does bad things for shareholder morale. This one is actually what they do is quite good for shareholder morale, because it does lead to expectations that what they're forecasting is going to be better. And I think the market is actually thinking that. These are soft sort of outlooks, but the market sort of ignored that. And when you look at the share price, what happened on the results day, it did bump up to about $315 a share. Okay, so this is their 2-year daily chart. Now, if I go back 2 years ago, if you remember late in 2018, which this goes back to then, there was an overall market correction. So the share price of CSL went down from about $225 to $170. It reached $170 three times and it bounced off $170 three times. So this red line here was a support line. It would have been a good time to buy there. Another good time to buy would have been around here at $190 a share, start of a trend. So you can just see here, change in sentiment around here at this line, and there was a good uptrend in 2019. And then it got really rich. You just see how the slope of these lines really increases. So this is getting a bit rich, I think, $340 a share. And then during the COVID crisis, a lot of volatility. You can see share price swings in a day, intraday share price swings were quite high. Got as low as $250, which is a good time to buy, I think. So I think this is area here, 250, would be a support line again. But overall sentiment the last 3 or 4 months has been neutral. So not much sentiment. The other thing I wouldn't notice is the amount of selling after this the results share price increase. There is a bit of thinking that if a stock price can't rally on good news or an increase in share price, that's not actually good. What's happened here? Share price has gone back down. So at the moment, my sentiment or the overall sentiment of the market is about neutral. I wouldn't be buying, I wouldn't be selling this right now based off valuations, based off sentiment, which are my two considerations. So I'm not a holder of CSL just yet. I'm looking for a good entry buy. Ideally, I'd love this to go down all the way to $150. If it went down to anything less than $100, I'd be backing my truck in. So what do I like about CSL? It's an amazing Australian company. End of story. Phenomenal long-term growth, and I think because the pipelines are strong, long-term growth can continue forward, even though one of my things I dislike, I'll get to that later. Great management, mostly, and they do great things for humanity. So ethical reasons, this would be a great company if you like that sort of thing. And who could not like that sort of thing, doing great things for humanity. Some things I dislike about CSL, lofty valuations. I would prefer this to be cheaper than it is, but I think you are paying a premium for CSL at the moment, and you have to take that into consideration. Soft growth in financial year 21 as per their forecasts, and whether I think the market is maybe seeing really good growth from then on. And that share buyback, I'm saying it's capital misallocation. Now they did that, probably I think it was less than $100 or so. So in terms of whether it was a capital misallocation, maybe they think it was undervalued at that point. But they could have done some other stuff with the money instead of buying back shares. And so that's all for CSL for today. Now, a reminder, I'm not a financial advisor, so if you do need some financial advice, make sure you speak to a professional. Otherwise, that's it for today. I hope you enjoyed this video. And whether you're a CSL shareholder or not, make sure you keep an eye on it, because it is one of Australia's great companies, and I think will continue to be so.